We would be beginning with the chapter 4 of CMT level 2, and the name of the chapter is time based trend calculations. So this chapter is more or less based on the calculation, so it involves a lot of statistics, but we'll try to just read the entire chapter, and we'll also try to go over the formulas which might be tested in the exam. And I would also advise that you guys have a notebook or something so that you can just write down whatever we're discussing. Okay, so what are the learning objectives? To begin with that, we will see that first of all, the most important thing when it comes to trading is that we need to know what the price direction would be, in which direction is the price going to move. So that is something which we need to keep in mind. And how do you approach momentum? So like we have already discussed in level 1 that momentum is a very important factor. Inventory various weighting methods for moving averages. So the different kinds of calculations of moving averages we have already seen. So now we are going to see what are the ways and what are the methods in which we'll weigh them, and the drop off effects. Now drop off effects is what exactly is drop off effect? We've discussed it when we were also doing the moving averages chapters, that there are certain moving averages which as the day progresses they drop off the data from the earlier days. So the earlier days data is not reflected, so that is not a good thing. So that is the drop off effect, and many of these indicators, especially when they are lagging indicators, they have this problem. Okay, so beginning with this chapter, we can see the purpose of all trend identification methods is to remove the noise. So whatever noise is present in the market, the main reason that we use these indicators is to remove the noise which is present in the markets, and because most of the noise is usually meaningless. So trends are somewhat dependent on the time horizon. So trends, like for example, if I go to the trading view chart, throughout this entire course and entire chapter we would be going over the charts over and over again. So let me just take an example of, let's say, gold. Okay, so if you look at the 1 second, yeah, so if you look at the chart, let's say we are looking at, just a second, yeah, so where were we? Looking at the gold chart. So this is the chart of gold. So what can we see? That on 1 minute time frame, we can see that the price is clearly making higher highs and higher lows. So that means that the 1 minute chart is in an uptrend. But when I switch to the 1 hour time frame, what can I see? I can see that the price had been coming down. So the same instrument, the same stock or the same commodity is having different trends in different time frames. So you need to keep in mind that different time horizons have a different trend. So the same thing can be following another trend in different sorts of time horizons. For example, on the daily chart, we can see that it is currently in an uptrend, right? But then if I go on, let's say, 1 hour, I was noticing that lower highs and lower lows were being formed. So throughout, not just this chapter, but all of the chapters, we would be again and again referring to the chart. So make sure to also have trading view and backtest whatever we are discussing in order to actually learn the concept. So yeah, where were we? Okay, so we are here. There are various formulas in this chapters and we'll be going over multiple formulas, so make sure to also have a notebook and write down the data. So what is forecasting and following? Following, when I talk about following, we are basically referring to following the trend. Whatever the trend is there in the market, that is what you need to be following. And forecasting is basically predicting what might happen in the future, and like having an idea about what exactly might happen and what would be the direction of the particular instrument. So forecasting means predicting the future price. It is desirable, but it's very complex. So we really don't know what might happen tomorrow. We really can't predict what exactly might happen to the price of the particular instrument. So we need to, usually whenever we forecast something, it is based on the past data, right? So that's the reason why we backtest. But we, just because a backtesting data is showing a particular signal, that doesn't mean that it's going to always be true in the future as well. Nobody can really 100% predict it, which is why we always say that trading is a game of probability. So the results are always expressed with a confidence level and the level of uncertainty in the forecast. There is always a lower confidence as you try to forecast further into the future. So the techniques which are most commonly used for evaluating the direction or the prices are known as autoregressive functions. Unlike forecasting models, they are only concerned with evaluating the current price direction. So whenever we talk about autoregressive functions, we are basically talking about the current price movement and not the past or not the future. So that exactly is an autoregressive model. So whenever if there's a question in the exam which speaks about an autoregressive model, you need to just remember the fact that autoregressive model means the model which is only concerned with the current price and it has nothing to do with the future or the past price. Okay, so like we had already discussed about lagging indicators, now we are going to discuss what a lag is. A lag is basically a delay. So when we go to the charts again and when we actually look at the, okay, let's just see the gold data. If we actually put a moving average, let's say moving average, simple moving average. Okay, so you can see that the moving average was going down here also, but then the price started going up. So you can see that the moving average is giving us somewhat a late signal, right? So that is what a lag is, and great effort has been spent trying to reduce this lag. So a lot of people have come up with a lot of indicators and like models which can basically compensate for the lag which comes with the indicators, but then it's still a problem, right? In an autoregressive model, one or more previous price determine the next sequential price. So if PT represents today's price, PT minus 1 would obviously be yesterday's price, and so on. So if there's PT minus 2, that would be the price of the day prior to the PT minus 1. Basic maths, right? So what would be tomorrow's price? If today's price is PT, then tomorrow's price will obviously be, just a second, would obviously be PT. Why can't I use this pencil? Just a second. Okay. Yeah, so PT plus 1 would be the next day, right? So here look at this. PT plus 1, which is the next day's price, is equal to A0 plus A1 PT plus A2 PT minus 1, and so on. Now what does that mean? Each price is given a weight. So we are going to weigh each price and the weight is basically taken as A1. And then it's combined to give tomorrow's price. So tomorrow's price is basically going to be yesterday's price with the weight, and then you're going to, give it a little bit more weight, right? And what exactly is E? Since we have discussed that we can never really be 100% sure about what the price will be tomorrow, we need to consider the error factor in it. So that is why we have E. So the simplest example is this. PT plus 1, which is tomorrow's price, and we have A0, which is the weight, A1 and P, yesterday's price, plus the error factor. And you can also see, so what is the formula of a straight line? It's y is equal to A plus BX. So this is the standard notion in a way a straight line is usually written, right? So that is also, one second. Yeah, so that is also something you can keep in mind. So the autoregressive model does not have to be linear. So you know what a linear is, right? Each prior day can have a non-linear predictive quality. So that means that we don't have to be sure that there is a particular pattern which is being followed. That is what is basically the core characteristics of an autoregressive model. Again, you can read this if you want to. Pause the video and read it. Alright. Now let's go to another statistical method, which is the least squares model. So until now we saw what an autoregressive model is, and by autoregressive model what we understood was that the current price is given the most important and we don't really care much about the future or the past, even though we are obviously using the past data in order to predict the price of the future. Now we have another method which is known as the least squares model. So what is a least squares regression model? It is again the same technique that is used to find the relationship between two markets. For example, barrick gold and cash gold, corn and soya beans. So when you want to find the kind of correlation between two different markets or two different instruments, and when you want to check what kind of a relationship do they share, you basically use the least squares model. And again, what are the factors which influence the price of a particular item, be it in the markets, be it in the normal markets, like going to a market to buy some products, or be it in the stock market or like a commodity market. it's always supply and demand. Supply and demand are basically the two things which influence the price of a particular product, right? So regression is always done based on that, and the factors which are influencing are always supply and demand. Most trading systems depend only on price, therefore, we will look again using the least squares model with time as the independent variable and price as the dependent variable. Now, time is always considered to be independent. You remember the straight line equation, and price is going to be the dependent variable. Why? You have always seen that most of these models consider price, right? Everything, more or less, the decisions which we take is always usually, like based on price. So due to that, we can say that price is dependent, price is always dependent. So the regression results will be used in an autoregressive way to forecast the price n days ahead. N days ahead again could be anything. So the slope of the straight line or the curvilinear fit will determine the direction of the trend. So the direction of the trend again will be given by the straight line. Okay, so that is my least squares models. Least square models basically just helps me identify the relationship between two particular things, and price is always the dependent variable and independent variable is basically the time. So time always has been independent. Think of the graph, think of the x and y axis, and think about the straight line whenever you get confused. Time is always independent, like always. Keep that in mind. Now we have error analysis. Now what exactly is an error analysis? A simple error analysis can be used to show how time works against the predictive qualities of regression. So time is something which works against. So the error analysis, the main idea behind the error analysis is the fact that time is always working against us. So when you're trying to predict the future, when you're trying to predict the price, time is one factor which has always basically worked against the qualities of regression, or not just regression, any of these forecasting methods. And I know that this chapter particularly might be a little bit boring and might be too statistical, but you gotta do because it is a part of your course. But there's a reason why I'm not going too deep into this, because you won't be tested to that level, but you need to still be aware of it. So even if you're not able to understand the entire thing in one go, you can always come back to this video and you can watch it again and then revise it. But you just need to know the basic idea of what a particular thing is. For example, you just need to know what why are we calculating E, why are we putting a weight, what is A is weight, what is the straight line, and how can we say that time is independent, and we can see that price is always a dependent variable. So these are the small pointers you need to keep in mind. So whatever will be tested in the exam that I'm anyway discussing, so don't try to go more deep into it and try to understand the whole thing. It's fine, like we'll cover most of it. So error analysis is, again, what does error analysis show us? Error analysis shows us that time is always working against the predictive quality of autoregression, right, or any of the forecasting method. Using 10 years of General Electric prices. So General Electric is basically a stock in the US stock exchange. So for the purpose of forecasting and for the purpose of explanation, they've used the GE stock. If you want to see that, then I can just pull it up maybe. General Electric. Yeah, look at this. So this is a stock which is listed. So they have just basically used this in order to explain it, which is not really something to care about. But yeah, okay. So they use the prices ending from 2010, and they calculated the slope and the y-intercept. And they found that 1, -2, -3, -5 and 10-day ahead forecast is found by projecting the slope by that number of days. The forecast error is the difference between the projected price and the actual price. So what we predict or whatever we project from before and what the actual price is on the day of what you have actually forecasted, that difference is known as the error. Obviously, the projected price, projected price means what we had assumed it to be, what we had assumed that it would be, and the actual price that it was. The difference between the two is basically the error price. So keep that in mind. So that's it about our intercept slope price. You really don't need to get into the depth of this, but I hope you understood what an error analysis is. And look at this, price You can see the difference between the forecast price and the actual price. Again, limiting the forecast to direction. To be profitable trading a trending system, it is only necessary to be correct in one of the following two cases. In more than 50% of the days, you are correct in predicting whether the prices will go up or down, and the average up move is equal to the average down move. So, predicting the direction has always been the most important thing, especially for technical analysis traders. Your forecast accuracy is less than 50%, but the size of the move is greater than the size of the incorrect moves. So these are the two cases which can be. But according to me personally, even in your personal trading, you need to always know in which direction will the price move. That is something that you need to be aware of, and that is something you need to be able to, predict it. Unfortunately, there is no way to prove a particular method of forecasting, moving average or whatever, will be accurate over all calculation periods. So we know that price is fractal, but at the same time, we can never be sure that a particular system would be the same in all cases. So there are times when it will work, there are times when it will not work. There will be months where you are profitable, and there's gonna be months which won't be profitable despite using the same particular system. So trending markets are what you need to be looking for. Instead of consolidations and sideways markets, you need to make sure that you are always a part of the uptrending stocks or downtrending stocks. Like, the stock has to be trending in a direction. There's no point of becoming a part of all these stocks which are sideways. Again, the methods which are discussed in the remainder of this chapter are intended to identify the direction of prices based on past data. Now that's what we are going to see. So this is again the regression analysis. If you want to go through this, then you can take a screenshot and go through this, but we've already gone over what the models say. Alright, so now let's just quickly see how much of the chapter is remaining. We have price change over time, moving average, and we have user friendly software, body average, types of moving averages. We've already done that, but we'll just quickly go over. And triangular weighted and pivot point, okay, standard deviation, GMA, accumulative average, top of effect. Okay, so most of the concepts we've already done before, so let's just quickly go over them. Yeah, so we have price change over time. So as the time passes, you know that the price is also usually naturally going to change, right? And now for the assumption purpose, M is momentum. So M is momentum, T is today. So these are the symbols which you need to be aware of. We've been discussing PT means price of today, PT minus 1 is price of yesterday, PT plus 1 is price of tomorrow. So M is momentum. So these are particular terms which you need to be aware of. So sometimes this is called the rate of change. Momentum, what is the meaning of momentum? Momentum means rate of change. At what rate is the price changing? That is exactly the meaning of momentum. So momentum and rate of change are incorrect names. In mathematics, this is the first difference, and it's physics, it's the speed. So the same particular the same meaning has multiple definitions. The same definition has multiple words which basically suggest the same thing. So that is something. If the change in the price is positive, we can say that it is uptrending, and if the change in price is negative, then naturally it is downtrending. Of course, this decision is based on only two data points. So if I compare whether the price today is more than yesterday, then I can say the trend is up. But that doesn't mean that it's the same on all time horizons, right? So that is how we are basically linking that how the price behaves over time. Now we have the moving average. We know what a moving average is. And moving average, I'm not going to go into detail because I've done a video on it. You can go and check the playlist in the description and check that out. If you're still not clear with moving average, then you can go to the level 1 playlist and you can watch the moving average video in the level 1 as well. So yeah, that is moving average. Quickly going to the charts and showing you what a moving average is. This is a simple moving average. You can change the length to whatever you want to. If you use a 50 moving average, this is how it will look on your chart. So this is my moving average, and it basically shows us the trend in a particular stock. So moving average, this is the statistical data. Again, PT is today's price, N is number, and this symbol is basically the summation. Okay, So rolling calculation period. What exactly is rolling? It means that the as the days increase, you are taking newer data into consideration, right? So yeah, why are we dividing it by 3? Because we are using 3 points. So how many points of data you are using, you're going to divide it by that. Don't get into the detail of it. It's pretty simple. Again, you can pause the video and you can read this. So number of points, number of data points which we are using, that is going to be considered as n. And when you talk about 200-day moving average, we know that 200-day moving average is used as a bias. For example, if a stock is trading above the 200-day moving average, then we can just assume that that is basically like, we can just assume that it is uptrending since it is trading above 200 moving average. But if the same stock is trading below 200-day moving average, then we can assume that it is downtrending. So there are various methods in which you can use it, and again you can see about a 63-day moving average. Now why would people usually use a 63-day moving average? They would use it because it would show us the quarterly changes, and if you use that, then you know there are 4 quarters, right, in a particular calendar. So in that way, a 63-day moving average would be useful. So there are various reasons why people use the moving average and customize it according to their own needs. Again, the length of the moving average might also relate to its commercial use. For example, a jeweler may purchase silver each week. So since the person is purchasing silver very frequently, so for them it's going to be a different type of moving average. For them it would be short term, right? But if somebody is doing something on a long term basis, for them probably they'll be using a moving average which is more on a long term side. And then we have the software. So TradeStation, you'll come across TradeStation in the entire CMT. Now I'll just quickly brief you guys about what TradeStation is. So TradeStation is again a mathematical software just like a spreadsheet, and moving average, like it's basically kind of like a coding, like how you do in Excel. These are basically what you would write in a TradeStation, but you won't be tested on the TradeStation commands in the CMT, so I'll just skip it. But if you want to, and if you are into like coding and stuff, and if you want to learn the functions of something, then you can like look at this. And I'm sure you already know these because these are basic spreadsheet notations. So these are something like, if you want to find the sum of something, a sum of a list, then on Excel you'll just put sum and on brackets you'll do list, right? Like these are basic notations which you, I'm assuming, obviously know. So just look at TradeStation, and if somebody wants to explore that, then you're free to do so. Okay, now we're talking about average. Now what exactly is average? The closing or the daily settlement is the most common price applied to a moving average. So you might be wondering, when we are calculating a moving average, what price does it use? Does it use the high price? Does it use the day low price, or the opening or the close? Most of these calculations are done on the basis of closing price. If you want to, you can always um, you know like customize it, and you can use the opening price if you want to, but most of them use the closing price, so keep that in mind. It is the price used to reconcile brokerage accounts at the end of the day and create the net asset value for the funds. And for futures trading, it is called market to market accounting. So when we're talking about normal stocks, then it is called as the NAV, which is the net asset value. But if you're dealing with futures, then it is called market to market accounting. Again, I'm not going into the detail of what are futures, what are options, because I'm assuming you guys know about it since you've cleared CMT level 1. So yeah, now look at this. This is the moving average, which is a 3-day period. Since it is a 3-day period, which is why we are dividing it by 3. So I hope you can understand this. And double smoothed moving average, double smoothed, again, we know what smoothing is, and we've done that earlier as well. So it's also based on the volatility. Now types of moving average. So the first thing which we have is the simple moving average. Simple moving average is just the basic moving average which we've already discussed, and I'm not going to the issue which comes when we use a simple moving average is the drop off effect. And then we have the average of method, or the average modified moving average. So this end of problem which we face when we are using a moving average, like we have discussed, the drop off effect, that is basically sorted when we use the average modified. And again, this is the formula. You don't really need to learn this formula, but if you want to, then you can. Then we have the weighted moving average. The weighted moving average basically allows significance of individual or group of data to be changed. If you think that a particular time period data or a particular data set needs to be given more importance or needs to be given more weightage, then you use the weighted moving average. So this is a normal weight multiplied by price plus weight multiplied by price, weight multiplied by price divided by all the weights. Simple calculations. It's, if you look at this, it feels like this is complicated, but it's actually not. It's literally just weight multiply the price of each day, adding it until how many days you want to, and dividing it by all the weights. Very simple. And then we have the comparison of moving average. So different types of moving average. Go on TradingView and see it for yourself, backtest it for yourself. The weighted moving average at time t is the average of the previous n prices, each price having its own weighting factor. So we know what weights are, and you can obviously explore it on TradeStation as well. So weight, I'm not gonna go over that because we've already done it. Weighting by group. Now we just looked at what weighted moving averages are, but what exactly are weighted by groups? Sometimes you would want to weigh the data on the basis of groups. So if every two consecutive data elements have the same weighting factor, then PT is the most recent price, and N, what is N? N is the calculation period, we know that already. So N, and there are N by 2 number of weights, then this would be the formula. Now the only difference in weighting by group is that the same weight is given to a particular group, so you need to keep that in mind. Again, okay, we have the triangular weighting. So triangular moving average is also again something which we've seen previously. So what really happens in triangular weighting, is that it attempts to uncover the trend by reducing the noise in both front as well as the back calculation. So the front of the data and the back of the data, both of them are evened out in the moving average. So you need to keep that in mind. Okay, and then we have the pivot point weighting. Now what is pivot points? If you ever use the pivot point indicators, then you will know that pivot points can be easily plotted on your charts. So see, they give you the most important support or resistances. S1, S2, S3 is the support. R is resistance. So pivot points are again very subjective in nature. So yeah, let's go back to the data. Right. So the pivot point moving average uses reverse linear weights. So it begins with a positive value and continue to decline, and they become negative. Earlier on, when we were seeing the normal weights, we were seeing that the number goes from negative to positive. But in pivot weights, in pivot moving average, it goes from positive to negative. So that is the difference between the pivot. Okay, then we have the standard deviation moving average. Standard deviation moving average is a moving average in which you basically have a standard deviation, which could be like of any period. And then we have the geometric moving average. Geometric mean is growth function. It's basically used in indices. Keep that in mind. And when it's not written over here, but yeah, when you are, it is right, yeah, index. So whenever you are basically trying to calculate something of a particular index, then you use the geometric mean or the geometric moving average. So that's about it. And then we have an accumulative average. So what exactly is an accumulative average? Accumulative average is a long-term average of all data. So the final value is dependent upon the start date. So it's not very useful because you need to understand that the supply and demand keeps changing. So accumulation, it's basically focused on accumulation. And then we have reset accumulative average. A reset accumulative average is modification of the accumulative average, and it basically changes everything. And then we have the drop-off effect. Drop-off effect is, you know what drop-off effect is. We've just discussed how the drop-off effect affects us, right? The earlier data is always dropped off when you're calculating it. Okay, so we have come to the end of the chapter. Let's just quickly go through what all we learned in this. So we saw what are time-based trend calculations. This chapter isn't that important, but you need to still go over it since it's given in the syllabus. So we saw the formulas, we saw what AO is, that is the weight, and we saw how weights are given, and we saw what a least squares model is, and we saw that the supply and demand is always given most importance. And besides that, we also saw that what exactly is the least squares models, right? And we also saw that what is the independent variable and what is the dependent variable. Again, time is always independent and price is always dependent. And then we saw what an error analysis is and the difference between the actual price and the projected price. And we saw what are limiting. So there are two things: you need to predict either the direction, or you need to basically predict the percentage of move. And then we saw about the moving averages, and we saw how they work, and we saw what an auto regressive model is, in which you basically just look at the current price. And yeah, and then we saw what a simple moving average is, we saw what a weighted moving average is, we also saw what weighting by group means, and we saw what a triangular moving average is. The best part about triangular moving average is basically it basically talks about what exactly is the USP of triangular weighted moving average. If there's a question which basically talks to you about why is triangular weighting average the most important, then you need to keep in mind that the most important thing is it reduces the noise in both the front as well as the back of the data. And then we have the pivot point weighting. So pivot point weighting is, again, what's the USP in pivot point weighting? In pivot point weighting, it uses the data from reverse, which is it starts from a positive value and then goes on to the negative value. And then we have standard deviation moving average. We saw what a geometric moving average is, and this is mainly used on index. And then we have what an accumulative average is, and we saw what the drawback is, that is that it looks at the most initial data. Reset accumulative, and then we have the drop off effect. So that's it with this chapter. I hope you understood this chapter. You don't need to go into any more further detail while doing this chapter. This much is enough for your exam. But make sure to backtest everything that I've explained so that you remember this and you keep it in mind, or make your own notes. And besides that, you can check out the description. I've linked the CMT level 2 playlist, and I'm going to try to come up with a new video every day. If not every day, maybe every 2 days, and we'll be able to complete the entire course of CMT level 2 by, let's say, September end. I'm assuming by end of September we need to be done with the entire course. So stay tuned, and if you haven't subscribed yet, then I would really appreciate if you subscribe, and if you like the videos, and you can share the videos with people who are pursuing CMT. And yeah, check out for the link in the description below. Thank you.